Hi everyone, Martin here. There is a Bank of England interest rate decision coming up later this week with plenty of speculation about negative interest rates. I don't think that we're going to go negative on interest rates on the 4th of February, and here's why. Negative interest rates might sound like a good idea in theory. If you borrow money, a negative interest rate could result in you being paid by your lender. Just imagine that for a moment. But for savers, you might end up having to pay your bank or building society interest. That's not such an appealing prospect. The case for going negative with interest rates from an economic perspective is pretty clear. With interest rates in negative territory, there would be less incentive to hoard cash savings, and that money would be more likely to be spent in the real economy. A feature of the massive money printing that's taken place since the onset of the global financial crisis and has dramatically increased since the start of the pandemic is how little of that cash has actually hit the street. There's a lot more money out there, but the velocity of that money is still slow, and it's velocity that leads to economic growth and also leads to price inflation, but we'll leave that to one side just for now. Negative interest rates and paying mortgage borrowers for their debt might be a route out of the economic crisis caused by the coronavirus pandemic, but it's also difficult to pull off in practice. Now, the British Building Societies Association has warned the bank that its members, building societies in the UK, would struggle to pass on negative rates to borrowers. The reason? Well, one reason is that their computer systems are not up to the task. We might even see an unintended consequence from negative rates, higher mortgage costs for borrowers, taking money away from the economic recovery effort. Mike Reginer, who is chairman of the Building Societies Association and also runs the Yorkshire Building Society, explained that negative interest rates would mean higher mortgage rates to protect profitability and also could damage the wider economy. He said, "I fear this would have the opposite effect from supporting the economy, as rates would go up for borrowers as banks protect their margins." Last October, the Bank of England asked banks and building societies to report on whether they could pass on negative interest rates to borrowers and savers. That request for information increased speculation that negative rates were on their way. Since then, the Bank of England Governor Andrew Bailey has dialed back the rhetoric slightly, but stuck firm with the idea that negative rates form part of the bank's toolkit for economic recovery. This new warning from the Building Societies Association suggests that banks and building societies are not in a good position to pass on a further rate cut. Reginer said that lenders were far from ready and negative rates were unlikely to meet their stated economic aim, saying, "I really don't think negative rates are a good idea. Obviously, it's not up to me, it's up to the bank, but there are a number of things that would make it very challenging." Dated computer systems aside, it would seem that banks and building societies are primarily concerned with their spread. That's the difference between the cost of them borrowing money and the price at which they can lend it out. If negative interest rates led to a tighter spread, there's less profit in it for the banking sector. With less profit, there might well be less lending activity. And with less lending activity, well, that's generally bad news for businesses, home buyers and individuals. There's also a strong argument for banks to continue paying at least something to savers should interest rates go lower than zero. If banks started to penalise savers for holding cash deposits, it would cause significant reputational damage to the sector, and the banking sector isn't exactly held in the highest regard already. Reginer continued, "I can't see a scenario where we charge our retail savers to leave their deposits with us. Banks would need to protect their net interest margins. If they can't pass the rate cut through to their savers, they have to put rates up for borrowers, and that defeats the object of a rates cut." My prediction, no negative interest rates this week. That's not to say there isn't some pressure within the Monetary Policy Committee to go negative. Only a few weeks ago, MPC member Silvana Tenreiro made the case for negative interest rates, saying they had worked effectively in other countries, with some of the evidence pointing to more powerful effects. She said that the effects of negative interest rates should lead to higher consumption and investment and boost net exports and inflation. Tenreiro also argued against negative interest rates leading to reduced banking profits, saying there is no clear evidence that negative rates have reduced bank profits, and also that several studies had found positive impacts once you take into account the boost to the economy. During her speech, Tenreiro concluded, "While we can never have complete certainty, negative interest rates should with high likelihood boost UK growth and inflation. Cutting bank rates to its record low of 0.1% has helped loosen lending conditions relative to the counterfactual, and I believe further cuts would continue to provide stimulus. So it's unlikely that we will see a consensus from the Monetary Policy Committee later this week, but I still don't think that they will vote for negative interest rates. What do you reckon? Let me know in the comments. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.